Welcome back to Rich Owl. In 1929, the stock market peaked. The crash that followed wiped out 89% of value over 3 years. In 1969, the same thing, down 36%. In 2000, the dot-com crash, down 49%. In 2007, the housing crash, down 56%. Every single one was preceded by the exact same 4 warning signals. In May of 2026, those same 4 signals just lined up again. The pattern is here. This is Rich Owl, where we break down the stories Wall Street wants you to ignore. Today, I'm going to show you the 4 signals that have predicted every major crash for 97 years. And I'm going to show you what to actually own when the music stops. 3 things in the next 8 minutes. First, the 4 crash signals and why they have a perfect track record. Second, why 2026 looks structurally worse than 2008. And third, 3 boring assets that historically explode when stocks crash. Signal number 1. The Shiller-Cape ratio. This is the price-to-earnings ratio averaged across 10 years to smooth out cycles. The historical average is 16. In 1929, it hit 32. In 2000, it hit 44. In 2007, it hit 27. Today, May of 2026, it sits at 36, the 3rd highest reading in American stock market history. Signal number 2, corporate profit margins. Margins are mean reverting. They cannot stay elevated forever. In 2007, exactly 13. In 2000, 12.5. Today, S&P 500 net profit margins are sitting at 13.4%, the highest in 70 years. Signal number 3, the Buffett Indicator. Total U.S. stock market capitalization divided by GDP. Warren Buffett himself called this the best single measure of where valuations stand. Above 100% is overvalued. Above 140 was the dot-com peak. Above 160 was the 2007 peak. Today, the Buffett Indicator sits at 210%, the highest reading ever. Buffett himself is now sitting on $325 billion of cash. Signal number 4, insider selling. Insiders sell their own stock when they think the next 18 months will be worse than the last. In a normal market, insider selling runs at about $3 billion per quarter. In the first quarter of 2026, insider selling crossed $12 billion, 4 times normal. Jensen Huang sold $1 billion. Mark Zuckerberg sold $2 billion. Bezos sold $3 billion in February alone. 4 signals, all 4 flashing simultaneously. The last time all 4 aligned this way? It was October of 2007. 18 months later, the S&P 500 had lost 56%. Pattern. 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 The market does not care about your portfolio. The math always wins. Why 2026 actually looks structurally worse than 2008? 3 reasons: concentration, leverage, and reflexivity. Just 7 stocks make up roughly 35% of the entire S&P 500 by market cap, the highest concentration in 70 years. In 2000, the top 7 were 10%. In 2007, 12%. Today, 35%. This is not diversification. This is a single bet wearing 400 outfits. Leverage second. Private credit now holds $1.7 trillion in loans. These loans do not trade. They are not marked to market like public bonds. The original 2008 crisis was triggered by exactly this kind of opacity. When stress hits, private credit funds will gate redemptions and a fire sale cascade hits public markets. Reflexivity. 40% of new equity purchases are coming from passive index funds and ETFs. When stocks go up, more money flows in mechanically. When they go down, the same mechanism flows it out. The same algorithms that drove the Magnificent Seven up 200% will sell them with no judgment whatsoever. There is no Buffett deciding to buy the dip. There is just code. Every crash is a transfer of wealth from the people who bought the top to the people who held what crashes don't affect. 3 things have historically rallied when stocks crash: Number 1. Long-duration U.S. Treasuries, ticker TLT. In 2008, TLT gained 42%, while the S&P lost 56%. When stocks crash, the Fed cuts rates. When rates fall, long bonds rally. Today, TLT yields almost 5%. Number 2. Gold. In 2008, gold gained 4%, while the S&P lost 56%. In the years immediately after, gold doubled. Central banks just bought a record 700 metric tons last year. Number 3. Boring, unsexy cash, or short-term treasury bills, yielding 4.8% risk-free. Warren Buffett owns $325 billion of this right now. The 4 signals are not a prediction. They are observation. The pattern is not theoretical. It has played out 4 times in 97 years and is now playing out a 5th. The crash is not a question of if, it is a question of when. Stay curious. Stay skeptical. Never confuse a great market with a great economy. I'm Rich Owl. Cheers. Stay curious. Stay skeptical. I am Rich Owl.